Good afternoon, everybody. So let me start off with throwing some color on our Q1 performance. So for us, I think we've started the year with a very solid performance in spite of the current the coronavirus pandemic as well as the nationwide lockdown, which affected the production capacities because of the loss of days. We were still able to show a strong performance, which puts us into a good position for the rest of the year. Our factories have worked really hard over the first quarter. In spite of having a loss of production in most of April, we managed to turn it around in May and in June, and we performed quite well for the quarter. Our backlogs continue to remain quite strong, and the industry segments that we cater to, namely pharmaceutical and chemical, continue to show a lot of traction. Our order book across all our product lines also remains quite strong, and our outlook for this financial year remains very positive. We will use the next few quarters to build on our Q1 performance and maintain the same the level of growth that we have been achieving over the last few years. In terms of other highlights for this quarter, we have, as many of you know, completed the acquisition of Dietrich Process System India's facility in Hyderabad. This facility will be most likely handed to us on the 1st of September. This gives us ready-made glass line capacity in Hyderabad. It will improve our presence in the region and help serve the customers in a much quicker and prompter manner. We have already taken steps to make sure that we hit the ground running. Our raw materials, our glass lining materials, our labor, our glass line sprayers, our vendors, our supply chains have already been geared up so that on September 1st, we are very quickly up and running, and we can start producing as soon as possible from that facility. That facility also will help us reduce the current backlog at the Gujarat facility, which means that our backlog will reduce by about 200 to 300 units, which means that we can now supply equipment faster to the customers, which will mean in turn that we can then go and capture some more market share as well. Like I had mentioned to you during our last call, our heavy engineering business has done extremely well. This is the first year that we have started the year with a very strong backlog, which means that this is the first year that heavy engineering business will perform up to the expectations that we expect from it. We have built a lot of capabilities over the last 2 or 3 years, and now they are finally bearing fruit. In our proprietary business also, we have a very strong order book. These orders are not standard equipment. We have managed to really upsell these equipment and really go after technology and innovative products, really trying to differentiate ourselves from our competitors, and I believe that we will see margins improving as well. The export business also continues to do well. Southeast Asia and Middle East have been markets that have been doing quite increasingly well for us. We have seen significant amount of order intake from these regions, which would then translate into better margins going forward. Lastly, our 2 new furnaces have also arrived on Indian shores. They are now on our way to our factories, and within the next couple of months, we should have that up and running, which will mean that we will have enough capacity to cater to the glass-line market here in India for the foreseeable future, and we can maintain our market leadership position. So with that, let me then open this investor call for questions, and I'll be happy to answer any questions that you may have. Thank you very much.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2.
Sorry, there is some disturbance in the background, so if there's somebody who's on this line, can they mute their call so that we don't have any disturbance, please?
Sure, sir. Thank you. Anyone who wishes to ask a question may press star followed by 1 on your touchtone phone now. Participants are requested to use handsets while asking a question. We have a first question from the line of Rohit from Progressive Shares. Please go ahead.
Hi. Though the numbers look optically flat, they indeed are a good achievement in the current scenario.
Yes. Hi, Rohit. So yes, you are right. Compared to Q1 of previous year and Q1 of this financial year, yes, the numbers are flat, but you must also understand that for Q1 of FY20, we had 3 full months of production. In this Q1 of FY20, we have month of FY21, we had about 2 months of production. There were many issues relating to labor, to supply chain, in terms of startup and things like that. In spite of that, I believe that we have still performed well. I believe a lot of other companies in the manufacturing sector will probably not have similar kind of performances. We were not very heavily dependent on migrant labor. Most of our employees are from local villages, so that helped us a lot. We also had a very strong backlog and materials in stock with us, which helped us. And then lastly, we used our financial abilities to make sure that all the bought outs that were required to complete this equipment were supplied to us in time. So I think going forward, many people would have expected Q1 to be worse than the Q4 of previous year. However, we've turned it around and we've actually outperformed Q4 of previous year. We're showing about the 17% quarter-on-quarter growth. In spite of having more off days than in Q4. So I think a lot of credit goes to the facility in the Gujarat. I think they've done extremely well to get up and running quickly. And again, like I said, it puts us in a very strong position to do well in this financial year.
I agree to that. That's why I said optically flat. I have 2 questions which are related to this new plant. So of this approximately 6 acres of property at Telangana, what % is currently used for manufacturing or was used for manufacturing by them? And what is the free land available to you for future expansions, if any?
So I think it's about 49,000 square feet has the covered factory area, but I'm not completely sure. It's around the 40,000 square feet mark. We do have significant ability to expand that facility. Not only that, that facility has not really had anybody invest in it for quite some time. It is something that has been continuing from the last 10-15 years. So we definitely want to bring in our own efficiencies. We've reached a kind of level at GMM Pfaudler in Gujarat that we want to bring and implement in this new facility and really ramp up both in terms of operational excellence as well as in terms of improving efficiencies. So we can bring that in, and as we bring that in as well, we will then slowly add new machines, new work centers, and look at improving the output from there. So in the first year, if we have a full year of production, we believe we can anywhere between 60 to 70 crores of output. Now that for this financial year, we have about 6 months of production available starting in September. We expect another the 30 to the 40 crores of output. But it's more of an opportunity cost for us. For us, it gives us 2 benefits. One, it gives us a benefit that we immediately are able to bring our backlog down. And 2, it gives us the ability to manufacture equipment locally, which means that we don't have to spend transportation costs from Gujarat to Hyderabad. We can now produce it locally and then supply it from there to the local market.
Okay. I understand that you are having a ready-made plant to gulp down the market share. But any views or any thought or calculation as to how many equivalent units was the plant able to make earlier?
So, we have no idea in terms of what they were able to make. Their processes are very different from our processes. Their firing cycles for glass-lined are very different. But in terms of what we expect about 400 equivalent the EUs in the first full year, and obviously that can be ramped up as and when we keep bringing in more and more efficiencies.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, please restrict questions to 2 per participant. If you still have more questions, please join the queue afresh. We have next question from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. Congratulations on a good set of numbers. So just to carry this further with regard to our acquisition, so we are adding roughly about 400 units, and over and above that, we were adding about 500 units at Gujarat, which is supposed to come by August and September. And you had already planned a Capex at Hyderabad. So roughly putting, I think from around 2,300, you are going up to almost 3,700. So firstly, whether your new Capex at Hyderabad, the new facility, would that get a bit delayed because of this acquisition? And if not, so do you feel there is, you are adding almost more than 50% capacity addition is happening in a span of 12 months. So is it that the market is growing at a very fast pace, or will you be taking market share?
Okay, so just to clarify, now that we have made this acquisition in Hyderabad, we will not be adding any further capacity. So the greenfield project was something that we had thought about because we did not have this option of this acquisition. Now that we've acquired this company and we have ready-made access, there will be no longer any investment in the greenfield project. So we will use this facility to produce in Hyderabad for the next 3 to 5 years, and maybe then look at maybe adding more capacity or even looking at a greenfield project at that time. So right now, for the next 3 to 5 years, we only have two facilities, one in Gujarat and the one that we just acquired from DDPSI, the India. So in terms of adding capacity, we are not really adding 60% capacity. Like you rightly said, in this financial year, once the new furnaces come in, our EUs in Karamsad, Gujarat will be about 2,300 units, and in Hyderabad it will be about 400 units. However, in Hyderabad, please note that we only have 6 months left since we will acquire this facility only in September. So we have about half of that, so about 2,500 to 2,600 EU capacity this year. We believe that the market is conducive. There is a lot of traction happening in both the chemical and pharmaceutical space. So one is that we will reduce our backlog, and whatever new orders that come in, that's something that we can also cater much quicker and much faster to our customers.
Sure. And so just one last thing. How has been the order inflow in this quarter? And do you find any difference in how the management are talking about their Capex in the time gap between our call for the fourth quarter and as we speak today?
Right. So there is definitely more traction on the ground. Because of the pandemic in Q4, things had slowed down. We are now seeing more and more managements now taking a call on new investments. We are seeing there is definitely some traction in the pharmaceutical space. There is the smaller players who used to order maybe 1 or 2 equipment are now going and ordering 6 to 10 equipment. It's not the big traction that we want to see in the big players, but on the ground level, it is happening. We do believe that Indian companies will look at localizing production of intermediates. There is going to be a shift from China to India. We believe the government is also pressurizing Indian companies to look at manufacturing locally. So all in all, I do believe there's traction in the pharmaceutical space. I think more traction will be seen in the coming quarters. Chemical still remains very strong. Our big chemical players still have investment plans. Major Capexes are on their way. And like I mentioned earlier, we've seen some traction in the international markets. We recently got 2 large orders from Southeast Asia, Malaysia and Taiwan, which also will be quite nice in terms of international and export business. But yes, so I think overall we are quite positive in terms of the outlook for glass-lined equipment.
So the order inflow numbers for this quarter?
Sorry, so I said the backlog numbers right now, I missed that. So on the end of Q1 of this financial year, we have about 330 crores of backlog on our books, executable backlog, and this is evenly spread between glass-lined and non-glass-lined, 50% with glass-lined and 50% with heavy engineering and proprietary products.
Thank you so much. Thank you so much.
Thank you. We have next question from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah, sir, congratulations on a great performance. Sir, for the Q1, how much of the sales or the growth would you attribute to the spillover sales from the fourth quarter, given we had shut down in the past couple of days of the fourth quarter?
Right. So it's a combination, again, double. Ready-made equipment, I would say, would be in the range of, let's say, 5 to 7 crores. But like there's always work in progress. And that also got the carried forward. So I would say in the range somewhere between maybe 15 to 20 crores. And then obviously we also created WIP in this quarter. So even though we could not ship everything this quarter, some of it will again spill over into next quarter. So we were quite cognizant of the fact that we need output, but we also need to create WIP, which can then be used in the following quarters, because as we want to grow in the next 3 quarters, we expect to be a significant ramp up in output, and the WIP that we created in Q1 will help us doing much better in Q2, Q3 and Q4.
Okay, great. Sir, on the heavy engineering part, can you elaborate more on the product side, and even the profitability wise we have been very healthy, roughly 20% that we have done. So can you elaborate a bit more on this and the way forward?
Sure. So heavy engineering is something that I've been talking for a long time. Many of you must be hearing my heavy engineering outlook. Every year I say it's going to do well, but this is really the first year we really hit significant volumes, right? So the absorption in terms of the fixed cost will finally come through, and that will affect the profitability. Last whole year, the numbers in heavy engineering were close to 50 crores. But in Q1, we've already done about 41 crores, right? So immediately you will see a big improvement in profitability. In the same way, the proprietary products did not do extremely well in the first quarter, even though we have a lot of WIP and we'll see a big improvement in Q2. There was not enough output for the profitability to improve significantly because of the absorption of the fixed costs, right? So yes, exactly. The reason why you've seen a big surge in profitability is obviously the volumes, the revenues have increased significantly, but again, we've also managed to have a good mix of the right kind of orders in heavy engineering. So we've had a little bit of export to the Middle East, we've had alloy material, we've had carbon steel, we have stainless steel. So the product mix has always been nice. And again, that's one area that I'm quite confident in is heavy engineering, and we have really spent a lot of effort to build in our capabilities so that customers will really regard us as one of the premier players in this industry segment.
So what would be the industry segment in which we have supplied given role?
So it's again a mix. There'll be oil and gas, there'll be fertilizer, there'll be chemical as well, maybe a little bit of pharma. But it's really the idea here is to kind of diversify from our legacy segments of chemical and pharma. So oil and gas, petrochemical would be a significant portion of this.
Got it. Okay, great. I'll come back.
Thank you. We have next question from the line of Sanjay Shah from KSA Securities. Please go ahead.
Yeah, congratulations Tarak Bhai and Ashok Ji on good performance despite these many challenges due to COVID virus pandemic. And sir, I wish you good luck for future. Sir, my major questions are answered, but sir, can you elaborate on heavy engineering side? What is our total rated capacity and what turnover we can do with the established facility, and what are we doing for increasing that later on?
So Sanjay, good question. We have, we do have additional capacity. The last 3-4 years, we've been 40-50 crores and odd. We can very easily, in my opinion, reach anywhere between 150 to 200 crores, allowing the right kind of product mix, right? So we have to be very careful here in terms of what we bring in. There has to be the right combination. If you bring in all carbon steel only, which is low value, you might not even reach 100 crores. And if you bring in, let's say, all stainless steel and alloy, then you can very easily even do more than 200 crores. So finding the right product mix is something that we are working on. We have a clear strategy in this front, but all in all, I believe that between 150 to 200 crores is currently our capacity. We have 2 large manufacturing sheds which we have built recently. One was slightly older, one is new. We have capacity available, and again, I think it's important to understand that for this business line, there's not a lot of Capex required. So even though if the business were to increase significantly, we can really bring and add manufacturing space very quickly by just adding space, right? So This business is something that, we have been quite bullish on. Finally, we have a time where we have a good starting backlog and a good order book, and hopefully now we can pick and choose good margin business that will, allow us to have revenue growth as well as profitability growth going forward.
That's great. So, Tarakji, can you highlight and elaborate on how our international verticals are doing? As you rightly pointed out, we have got good orders from Malaysia and all, but how our subsidiaries are doing, Mavag and all, and what are the opportunities you see outside India?
Right. So Mavag, for all of you, it's going to do extremely well this year. GMM obviously started with a very strong backlog, but Mavag has started with an even better backlog. Last year, I believe they did something like 12 to 13 million Swiss francs, maybe slightly lower than that. So this year, they have a very, very strong backlog. So you will see significant improvement in both Mavag's revenue as well as bottom line. Many of you will know that their break even is about 10 million Swiss francs. And we hope for them to they perform very, very well, because the order book is already on hand. Now it's only execution, and they, unlike in India, have had no lockdowns, and you will see in the next few quarters that their numbers will keep improving. Our parent also continues to do well. So like we have seen in India, there is a buzz around the world in both the chemical and pharmaceutical industries. Like investment is coming back on Indian shores the same way there is investment that is going back in the US and European markets as well. Many of these countries have realized that they had over-dependence on both India and China, so local capacities are being created. So I think globally, chemical and pharmaceuticals are two industries that seem to be somewhat insulated from this crisis. And I think over the next maybe 3 years or so, you will see a good amount of investment in new capacity being added.
That's great. So my last question.
I'm sorry to interrupt. Please come back in the question queue. Mr. Shah, thank you. We have next question from the line of Kaushal Shah from Danki Securities. Please go ahead.
Yeah, good afternoon, sir, and congratulations on a very good set of numbers. So I had two questions. One was, if you can throw some light on the Capex that could be required. You mentioned about the fact that DDPS, there could be some investment required for you to streamline some activities, or their work processes are a little different. So what would be the likely Capex that, could be required in that facility for us to, kind of get started in a meaningful way? And the second question was on the heavy engineering side, when you mentioned about the order book. So if we do the math, roughly heavy engineering has an order book of, I would presume, in the regions of around 80 crores, which is roughly, let's say, two quarters of work. So are we expecting additional orders as we go forward in heavy engineering, when you mentioned that we are likely to see significantly better performance in the current year?
Right. So maybe I'll answer the first question. The plant that we bought from DDPSI, I think it's important to understand that it is still a good plant. It's a well-maintained plant. It is run by a French multinational, so the systems, the quality levels, the maintenance of the equipment is quite high. So I don't see a lot of Capex happening there. I think maybe a Capex in the range of maybe 8 to 10 crores over the next 3 years, right? So that's something that's more, it's mainly in terms of just getting the plant painted, cleaned up, some new small equipment, small cranes and things like that. So no major Capex will go in. And the numbers that we have planned currently are without a new furnace. There could be a possibility that if the markets are conducive, the markets are growing, we might even add a new furnace in Hyderabad. That's something that we have not taken a call of right now, but in maybe the next 6 months to 1 year, we will take a decision on that. There is space available to add new furnaces and then really ramp up the production capacity there. In terms of heavy engineering, yes, you should understand that, yes, business is good, but however, some of these items are long lead items. So even though we have a good starting backlog, maybe Q2 might not be at the same level, but for the year, definitely you will see a significant improvement in the HE production and the output. There is capabilities. We still have capacity available for Q3. There is a shortfall there by a few crores. but in Q2 and Q4, I think we are booked solid. So for this year, we are now done. So now we are focusing on the booking business now for the next financial year. Again, having a good backlog to start the year will again help us grow further in this business line.
Thank you. Thank you very much.
Thank you. We have next question from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thank you for the opportunity and congratulations for pretty decent set of numbers. Sir, on the pharmaceutical side, if you can highlight how has been the order inflow or inquiries, because what we have been hearing and what the government has been planning, the incentives that they are planning to give for setting up API or intermediate plants in India, like there are big incentives coming in. So if you can highlight how has been the inquiries and have the inquiries started getting translated into confirmed orders, and how will this impact both our GLE business and the AMFT business that we have on the proprietary side?
So yes, so I think that's a good question. I would not, if I were to be honest with you, it's still going to take some time. Even though there's a lot of talk, there's a lot of government pressure, it's too early for it to translate into actual orders on the ground. Having said that, there are smaller players, intermediates who supply to the bigger guys who have started now investing in new capacity. So I've said that the tier 2 pharma guys, we've seen a traction there. Instead of them buying 1 or 2 equipment like they have been doing for the last 5-6 years, now they're buying 8 to 10 equipment. So they are definitely adding capacity. And that's probably a reason because Indian companies are now saying that why don't we have more local supply? So that's happening at the ground level. However, to see a big change in, let's say, Dr. Reddy's or Sun Pharmas or Ciplas and Lupins of the world, I think that will take some time. There is a clear shift in policy for sure. Like you mentioned, the government is forcing players. We have heard from customers like even the specialty chemical, the customers, that there is direct contact from central government to ask them to look at manufacturing intermediates locally. So all this is happening. The government has also identified 3 clusters for intermediate and pharma manufacturing. One of them, like you know, is Pharma City in Hyderabad. But again, to translate it to actually on the ground, I think that will take some time. I think it will take a couple of quarters. Pharma City is still maybe a year and a half, 2 years away, maybe even more. But I think now the government will definitely push to move that a little bit faster so that over the next few quarters we will see some traction there. In the meantime, the chemical business still continues to remain quite strong. So, we still do have some time where business is not a problem. The market continues to grow. And by the time the pharmaceutical picks up, we will see that, then we will have additional capacity as well. Just one more point here, I think for you to understand is that pharma plants, especially the older ones in Hyderabad, have now reached their life cycle. People are looking at upgrading these plants. Now with FDA issues coming in, people are looking at revamping many of these plants. So, not only demand from new investment, but even demand from replacement business will pick up in the coming quarters.
Sure. And but have you started seeing inquiries from some of these large companies? I think Divi's, I think we have already supplied to them. So any additional inquiries from large companies like Divi's or Dr. Reddy's or Ciplas, or they have not even started inquiring? So
I would not compare Hyderabad Pharma with Mumbai Pharma. So Hetros, Aurobindo, the Divi's have always invested. Every year they have projects. Hetero recently invested, Divi's recently invested, and they will continue to invest. So that will be continuous businesses. Aurobindo also is very bullish. However, Sun Pharma also recently did a bit of investment, but their investment is more in terms of operational improvements and efficiency improvements. They are revamping their old facilities and really trying to extract as much efficiency. So there are different strategies at play for different customers. Many of these also have the different products and markets. But overall, I think you will see a shift of intermediates. I think, that is something that the government is very, very strong about, that they believe that our dependence on China is significant, and that's something that we should reduce over time.
Sure. And how much of our current backlog is from pharma and how much from chemicals? If you can give us the broad breakup.
So about 50 plus is from chemical, 55% is from chemical, about 30 to 35% is from pharma, plus or minus 5%.
Okay, and this was almost say a year and a half back. Like, pharma used to contribute more compared
to... Exactly. So we are pretty much at the same level still.
So, thank you so much. Thanks, sir.
Thank you. We have next question from the line of Deepak Mehta, investor. Please go ahead.
Yes, sir. Thank you for taking my question and good set of number. Congratulations. My question is that as we have seen good momentum in first time in the heavy engineering. So we have added any new logo or it is from our existing clients, sir?
No, it is all from our existing facility in Gujarat. We have 2 sheds already available, and we've not added any additional capacity in heavy engineering.
Okay, and what is the order book right now for heavy engineering, sir?
So like I mentioned, the total order book on the end of the first quarter was 330 crores for the entire GMM Pfaudler, out of which half is for glass lined and half is for non-glass lined. So if you do your calculations, you can calculate that it will be 25% for the 2 product lines that are not part of the glass line business.
Okay, thank you, sir. And one more question, that we are already doing great as a company. So what headwind we can see due to Atmanirbhar Bharat? So I think there would be some good push for our company as well.
So yes, there is definitely opportunities. I think that, having a significant competitor leave India and not compete with us for the next 3 years as part of this agreement of purchasing this acquisition and this land in Hyderabad, that will be a significant advantage because we are indirectly now the only quality and technology glass line equipment brand in India. Everybody else is not a global brand. They are all local players. So we definitely now have a differentiation and market the leadership. So that's something that's going to be beneficial to us. Like I mentioned, that our ability to have access to this facility by the first week of September is also very important because right now the need of the day for us is to reduce our backlog and to give faster equipment, faster supply to our customers. So that will help us. In both the other businesses, the proprietary products and heavy engineering businesses, we already have pretty much a backlog that takes us to the end of this financial year. So we all only have to now execute. Financially, we are stable. Materials are not a problem. Our factories are now working at full capacity. So we are in a good situation. My only hope is that this virus does not, the result in us having to close down. I don't think that is the case because we have a lot of SOPs and precautions that we have built in. But, you never know with this virus. But it seems that things are now opening up and things are getting better. So I believe that you will see better performances from the company in the coming quarters.
Okay. Thank you so much, sir. Best of luck for the rest of the year.
Thank you.
Thank you, sir. We have next question from the line of Hasmukh Gala from Finvest Advisors. Please go ahead.
Hi, Tarak Bhai. Congratulations for a very good set of numbers. So just 2 questions from my side. One question is, as on 1st of April, we started with order backlog of about 350 crore, what we disclosed in Q4 conference call, and now we are saying 330. Does it imply that the inflow of orders have been lesser than what execution has been?
No, I don't think so. I think while we have executed, we have also booked. You will see some small changes between, every month, but the trends continue to remain strong. 1 or 2 months of poor orders because of the pandemic, like I mentioned, April would have been a very slow month, but things are picking up again, but nothing alarming because we have enough orders to take us at least for this financial year. We probably have some capacity in Q3 and Q4 for certain product lines, but that's something that we will very easily, if you maintain the same run rate of order book, we will meet those numbers very, very easily.
Okay. Sir, on proprietary products, I think which includes this Sudarshan Chemicals business, how that is faring?
That is doing also quite well. I think overall we have a very strong backlog in the proprietary orders, the business. However, our Pune facility was shut for a little bit longer than our Gujarat facility. So that is something that we'll make up. But yes, these orders are of good quality and high margins. And I think this is one product line again that you will see a good amount of growth. You will see a significant improvement in profitability because like I mentioned, we are now focusing on high margin business, not the standard products that some of our competitors make. We've been able to differentiate ourselves here, and we have a good amount of order book from our subsidiary in Switzerland as well, Mavag, which manufactures most of the components here locally in India because there's a cost advantage, has also seen a good upsurge in orders, which has translated into more business for us.
Right. And sir, in heavy engineering...
I'm sorry to interrupt. Please come back in the question queue. Thank you. We have next question from the line of Srinivas Iyer from Rockford Consulting. Please go ahead.
Congratulations, sir, on your good numbers. Now, in the last Concall, you told that the gas furnace imported, 2 gas furnaces are going to be installed by June, July. So, has they come or it is yet to reach your site?
Right. So they have now arrived at Indian shore. They are now under custom clearances and they will soon be moved to our factory in Karamsad in Gujarat. And we should now see them operational in the next couple of months. There has been no further the delays or anything like that. We will now get them operational as soon as possible.
Okay. My next question is, sir, because the low floating stock, the share trading in our counter is very low, less than 20,000 every day. So why don't you consider a liberal bonus so that there can be increase in the floating stock and FII and institutional participation will be more?
Sure, we are always looking at ways of increasing the free float. I think both the Patel family and DBAG, who are the other promoters, have spoken about this in the past and keep speaking about this. We definitely want to add more visibility and higher quality of investors as well. And if there's an opportunity to do so, I'm sure that we will do it.
Thank you.
Thank you. We have next question from the line of Dhawan Shah from ICICI Securities. Please go ahead.
Yeah, so I have a question on the GLE segment. So out of this Indian GLE market of roughly 600 odd crore, so how much comes from Hyderabad and Telangana, and what is our overall market share for this market?
I would say about 100 plus crores would come from Hyderabad and Telangana. We still have a market leadership position there. We would be in the excess of 50% easily. It has not changed. The benefit now with this new plant is obviously that we can increase market share. We can also save on transportation costs. We spend nearly 6 or 7 crores of transportation costs every year by sending equipment from Gujarat to Hyderabad, so that can be completely eliminated. And then obviously being closer to our customers, we can even go after the smaller customers that have been missed out now. So we can definitely look to increase market share in Hyderabad.
So sir, out of this, you mentioned this 100 odd crores. What kind of opportunity size do you look at in the next 2 years? What kind of, the potential for this Hyderabad, Telangana, if the replacement demand comes up, like you mentioned, that many of the pharma plants are old, so the more replacement demand are going to come. So what kind of market potential do you see out of from this 100 odd crore? Can it reach to 200 crore in next 2 years or 3 years?
Yeah, so 100 crores is only our, our market share. There is also local players and some other players who also cater. So I would say the market size could be in the range of 250 crores. So one, we can still go after market share. 100 crores can increase to 150 or 200 crores by taking market share. Like the only reason some of our key customers don't give us business currently today is because they have issues with the timelines and deliveries. So if we can maintain and make sure that we can deliver on time, a lot of that business will come to us automatically. you must also understand one major player has left India, right? So there is a vacuum that's going to be created. That market share is up for grabs. Somebody has to grab it, and since that player was a technology leader, it's very difficult for a value player or a low quality player to take that market share. That market share will automatically come to us. But yes, looking at Hyderabad, looking at new capacity being added because of Pharma City, looking at new replacement capacity, I do believe in the next 2 to 3 years you will see definitely demand going up in pharmaceuticals. There is going to be investment in new pharmaceutical facilities. And one of the other things important to keep in mind is when people build plants today, they do want to build world-class facilities with the FDA issues. Most of these customers are international players. They have audits all the time. People no longer want to save money on equipment. They want peace of mind. So they usually want to go after branded and high-quality products.
Right. And my second...
I'm sorry to interrupt. Please come back in the question queue. Thank you. We have next question from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Yes, sir. It is indeed a very good result due to COVID. Sir, what is your view? What is government is doing for this chemical industries and pharma industries which need shifting some business from China? First question is that.
Right. So government has been saying a lot of things. A lot of people have been talking about it, but we again need to see actual decisions at a ground level, which I think is still lacking. I think a lot of pharmaceutical players want to do and manufacture locally, but the government has to support them with SOPs or some kind of leniency in terms of taxes or power or what. Some additional benefits have to be passed on to these manufacturers because business is there and most of these guys can make things locally. The only reason they buy them now from China is because the Chinese cost structure is much, much lower than India. So if we can see some amount of subsidies coming into Indian market, then you will see a lot of Indian companies putting up plants very quickly and then taking advantage of that. So again, government is talking and making all the right noises. However, we need to see actual the decisions at a ground level.
So do you think such this noise will convert in reality?
So I have seen recently, last week maybe, there was some decision where the government had earmarked about 10,000 crores for API intermediate manufacturing. But again, I think it's too early to say. I think this is a push of this government. They have been saying for the last, I think, 3 to 5 years, even before this pandemic and even before we had issues with China, that our dependence on China for intermediates was very, very high. I think now you will see real action on the ground in the coming months because the government is now pretty certain that they will have to do this to safeguard our national interests.
Thank you, sir. We have next question from the line of Ronak Vora from AUM Advisors. Please go ahead.
Hello, sir. You said that the order book that you currently have is around 330 crores. So out of that, how much would be the advances that we get?
About 30% approximately. It depends on product lines. In some products you might get higher, some products you get lower, but the advances would be around 30% or so in general. I don't have that data, but I'm just giving you a kind of a rule of thumb.
Okay. Thank you. That's it.
Thank you, sir. We have next question from the line of Salil Desai from Marcellus Investment Managers. Please go ahead.
Thank you, sir. I wanted to carry forward the question somebody asked on proprietary products. The profitability there has been elusive for the last 6-9 months. When we've already had a couple of new product launches there. So how will you see that panning out? When do you really see that new products or the higher margin products start contributing meaningfully?
So, Salil, we've actually seen a lot of traction here. We recently launched a product called the Spherical Dryer, which is a world-class dryer, which in the past we've launched this product maybe 4 or 5 years ago, and we've actually sold maybe 2 equipment in the last 5-7 years. However, this year we've sold close to 7 of them, right? So these are very high value, high cost dryers, but really show a significant improvement for the customer. There are specific products that the customer makes, and one example is a product called Valsartan, which has a drying time of close to 36 hours. We have seen that this product reduces that by about 50%. So when a customer has a high value product like Valsartan and they can reduce the drying time by 18 hours, that's a significant improvement in batch time, and we've seen a lot of traction in that product line. We also see that customers are now more interested in doing a complete system rather than doing just individual equipment. So they want us to add instrumentation, piping, heating and cooling, automation and stuff like that. So that's something that we've been working on, and we're really going after and differentiating ourselves from being just an equipment supplier.
I see. And second is many congratulations on the DDPS completion of the acquisition. Here, how about staffing? Do you inherit the people there, or will you have to kind of do the whole staffing again? And
yeah. So Salil, I think we spoke about the capital allocation in the past, and obviously I think this is a really a nice way of allocating capital for us because it's something that we know quite well. We have over the last 3 or 4 years really excelled at the execution at GMM in our the Gujarat facility. So the idea is to very easily just cut paste what we have done there and move it to Hyderabad. The good and the beauty of this deal is that we don't have to take a single person. We can pick and choose who we will take. So our cost structure in Hyderabad will be significantly lower than that in the Gujarat facility. As per the agreement with DDPSI, they will retrench and terminate all their people, and then we have the ability to take whoever we want depending on what we need. So there is no liability on us going forward. So it's just an asset transaction. We get the factory, we get the building, we get the plant and machinery, and we get a 3-year non-compete, and then we can choose whoever we want once all the employees are terminated.
Great. Thank you very much.
Thank you, sir. We have next question from the line of Apurva Shah from Phillip Capital. Please go ahead.
Yes, sir. Thanks for the opportunity. So my first question is on GLE. So, sir, out of 330 crores of order book, is there any revenue from our parent or partner? And is there any incremental order or inquiry have you seen from that segment? And what is your view for orders from parent?
Okay, so on the GLE segment, we don't have any new orders from the parent company. Like I said, our focus is on India. The Indian market is booming. But something just to let you know, we have got 2 very large orders for glassline equipment from Taiwan and from Malaysia. This will be in the range of maybe 10-15 crores. Which will be high value and high margin business as well. So export is something that we are working on. However, this export would not have been possible without the support of our parents. So we worked on it as a team. So that is something that we continue to work on, and the parent itself is more open to using GMM in certain markets where the competition is higher or the price range is lower. So that has been something that's a positive. And in terms of other export business, we do see a lot of traction with the parent when it comes to the non-glass lining business, heavy engineering and proprietary as well. So that will continue to grow over time.
Right, sir. And so my second question is on heavy engineering. So in last 2-3 quarters, your commentary seems very optimistic for the heavy engineering segment. So is it the right understanding? Do you see heavy engineering as a next growth driver? And if that's the right assumption, then over next 3 to 5 years, what kind of revenue contribution you envisage? So currently it's around 10% of our revenue. So can that go up to 30-40% in maybe next 5 years' time? And if again the answer is yes, what can be the revenue profile in that scenario where your revenue mix changes from GLE to non-GLE from current to maybe 60-40 or 50-50?
Right. So, every year we say that GLE will slow down and we expect all the other businesses to do better, but every year GLE surprises us. I still believe for the next 3 years, GLE is going to be one of the most important and the biggest part of our businesses. It is also the highest margin business for us, so we can never lose track of GLE. And now with the new facility coming up in Hyderabad, plus the 2 new furnaces, you will see growth in the GLE segment, both if the market grows as well as for market share improvement. So that's going to be a focus for sure. HE is something that, yes, we have built capabilities over the past. We now have a very strong team of salespeople who have been working very, very hard to get us accredited, approved by different vendors like Tata Project, by like Toyos, like EILs, like L&Ts of the world. I think that you will see a good amount of traction there. And the proprietary product range also continues to grow because that is one more area where the Indian customer is now looking for high technology products, looking at cost saving through either power saving, batch time improvement, more efficiency. So all in all product lines are growing. I would not say that one will replace the other, but I don't see a drastic change in terms of the product mix over the next 3 years. I think glass-lined will still be in the 60% range, and that will continue to grow. 60 to 70% range, and then the heavy engineering will grow probably at a faster rate because their starting point is much lower. And this year will be the first year where we will have significant improvement in revenues in heavy engineering, and you will see also a good amount of improvement in the proprietary products segment as well.
Thank you, sir. We have next question from the line of Sandeep Tulsian from GMM Financial. Please go ahead.
Yeah, good afternoon, Tarak. I hope everyone at GMM team is safe and sound with the coronavirus impact. Just have a couple of questions from my side. Firstly, if you can highlight the client profile difference between DDPS and GMM, how complementary were they, and which are the new customers where you can possibly make an entry to this acquisition? That's my first question. And second, I wanted to understand one of the comments that you had made during the previous Concall, that there are some companies which are moving production out of China is what you hear from the Pfaudler's global network. If you have any update or any examples that you can share on that front.
Right. So DDPS and Pfaudler, Dietrich and Pfaudler are the global leaders in terms of glass-lined equipment. Both are recognized and have the same reputation when it comes to high quality, high technology products. In India as well, if a customer was comparing GMM with somebody, they would first compare us with DDPS. So very complementary set of products, very similar. Obviously, their only limitation in terms of the Hyderabad facility was the size. They could go up to only 16,000 liters because their furnace did not allow them to do more than that. GMM Pfaudler obviously has a size range up to 80,000 liters, so there's significant difference in terms of capabilities. But all in all, I think when we bring our efficiencies into this facility, we can really ramp up quickly because their production cycle is very different from ours. They were obviously bringing a lot of components from Europe as well, which was affecting their cost structure. But here in India, we make everything locally. And again, economies of scale will also play an important role in terms of improving profitability. When we are buying more steel, when we are buying more glass, when we have more gearboxes, motors, all that thing will add value as well. So DDPS in that terms will be something that we will keep a cost structure in Hyderabad much lower. In terms of customers, I would not say that there would be a significant amount of customers that we would add because we anyway know all customers in and around India. There could be a few small players who would be buying from DDPS only, and we would get those customers back. But otherwise, I think that most customers are well known. Our sales teams are very strong. Our market share across India is quite strong. So winning new customers is really not an important part of this transaction. And then lastly, on the Pfaudler network, like you mentioned, we are seeing traction again. The traction is more talk right now. People are saying this. It will take a few months to see actual, it actually happening at a ground level. But most countries, most governments have a bit of negative connotation towards China. I think that will play through and you will see investment, local investment picking up across the world.
Thank you, sir. We have next question from the line of Jason Soans from Monarch Networth Capital. Please go ahead.
Thanks for taking my question. You had mentioned about, your exposure to pharma and chemical sectors, how it has changed over the years. I just wanted you to repeat that if possible.
Sure. So historically, pharmaceutical would have nearly account for about 55-60% of our total revenue. Now today, the chemical sector, which includes both the includes the agrochemical and specialty chemical sectors, would account for nearly 50-55%, right? So that switch has happened, and pharmaceutical has reduced to about 30-35. There have been some reasons for this. There has been obviously pricing pressure for pharmaceutical companies in the US. There have been FDA issues here locally. And there's also been issues relating to manufacturing capacity and approvals. So having said that, we haven't seen a lot of investment in pharmaceutical over the last 5 years, maybe, which is really, and the growth that has come for us has been really driven by chemical, pharma, the chemical, when I say chemical, agro and specialty, because of the pollution control norms and the slowdown in China, a lot of that production has moved here. So our growth over the last 3 to 4 years has come from the chemical industry. However, going forward, there seems to be somewhat of the revival in the pharmaceutical at the ground level. However, for us to see a complete revival, I think that will take some time, maybe a few quarters, depending on government policies as well as local manufacturing. I think that is something that we hope to see in the coming quarters.
Sure. And sir, about orders with respect to pharma and chemicals, any differences between margin profile or the revenue potential between these two sectors, if you could highlight some?
So not really. You will find high margin business in both sectors. The equipment side in pharmaceutical is much smaller. The equipment side in chemical is much larger. So maybe the order value side could be significantly higher in chemical. The reaction itself in our chemical plant is much more intense. It is more corrosive, while in pharmaceutical it is a little bit easier. However, having said that, pharmaceutical has a lot of controls like FDA and audits and things like that, so their quality levels also are quite high. So in both businesses, it's very similar in terms of quality. It's very similar in terms of technology. There could be more add-ons and bells and whistles in the pharmaceutical segment, while in the chemical, the sizes would go much higher.
Thank you, sir. We have next question from the line of Anush Mehta from Dalal & Broacha. Please go ahead.
Sir, I had two questions. My first question pertains to the number of manufacturing facilities that the parent is actually having as of today. Because there are a lot of news that the parent has shut down quite a lot of the facilities globally. That is one question. And second question is, in heavy engineering, is the sector that's driving the growth is same as compared to GLE?
So I didn't understand the first question. Sorry, were you asking about the Pfaudler factories around the globe?
Yeah.
So they have not seen significant shutdowns anywhere except in China. China, they were moving to a new facility which was then pushed back by a few months, has now recently started. But in Europe, most factories were running across the entire pandemic. US also was running, so nobody has seen any shutdowns. There were some shortages with terms of supply chain and things like that, but no material adverse impact in any of those facilities. And the second question, sorry, was
the sector that's driving growth for heavy engineering is same? I mean, the sectorial breakup is same as that for our glass-lined equipment, or there are distinct sectors driving growth for
There is definitely growth coming from chemical industries. There is definitely growth in that sector. However, there's also new sectors that we are focusing on, like oil and gas and petrochemical, which will also add to the normal legacy sectors of chemical industries that we are catering to.
Thank you, sir. We have next question from the line of Kirti J from Sundaram Mutual Fund. Please go ahead.
Hello, sir.
Yeah, hi.
Sir, how will our capacity addition will happen, sir? This unit, I believe, will add 600 units on equivalent basis. With the two furnaces along with our base capacity, what will be our exit monthly capacity available at the end of FY21?
So at the end of FY21, we would have capacity in Karamsad at the range of, let's say, 2,300 to 2,400 with the new furnaces. And in Hyderabad, we will have starting capacity of about 400 EU, so a total capacity of about 2,800, 2,900 units. Just keep in mind that in Hyderabad, we have already lost 6 months, so we only have 6 months of production available. And with these new furnaces in Karamsad, in Gujarat, we will keep adding more and more smaller initiatives of reorganization, some small equipment, which will then add more and more capacity without really adding new furnaces.
Okay. So we will be at the level of 250 per month in the March, right, sir, in terms of the production availability?
Yes. So we should be up to 225 now in the Gujarat, and we would do another 40 or so in Hyderabad. So yes, on a total basis, around 260 would be something that's very much possible immediately. And then going forward, we would look at ramping that up as well.
The Hyderabad maximum we can do only 40, sir, with the available factory.
So right now for the first year it's 400 units, and if you divide 400 by 10 or 12 or whatever you get, you'll get about 40 to 50 per month. But as we keep going in and reorganizing and working our efficiency, we'll see that improving over time.
Thank you, sir. Ladies and gentlemen, that was the last question. I'd now like to hand the conference over to the management for closing comments. Over to you, sir.
Yes, so I think a lot of questions and a lot of answers, hopefully they were clear. So I think we look forward to having you on our next call as well. Just to give the closing remark, we are very happy with our performance in the first quarter. We believe that we have created a very strong foundation to help us achieve our targets for this financial year. And looking at the current backlog that we have and the markets that we cater to, we don't believe that there is anything to worry about. The next 3 quarters are something that we have in our control, and we will continue to perform well over the coming months. And hopefully our numbers and our results will be something that will be positive for the market. So thank you very much, and I look forward to speaking with all of you at a later date. Thank you.